Everyone's talking about the big, beautiful bill, but here's the part that no one is telling you. It's not just about taxes going up or down. It's a complete reshuffling of who wins and who gets blindsided. I'm Terrell Higgins, your personal finance guide, and I spent the last few weeks going through this 1,000-page tax document so you don't have to. And what I found is either going to save you thousands of dollars or it's going to cost you thousands because you're not prepared. I'm going to break down the 5 biggest changes that are going to hit your wallet, who the biggest winners are from this tax bill, and what actions you need to take before 2028, because some of these changes have a deadline that can sneak up on you. Let's get into it. First, let's talk about what almost happened and why you should care. Your taxes were about to go up big time. Those tax rates that we've been living with since 2017, they were temporary, and they were set to expire at the end of the year. Most Americans were facing a 3 to 4% increase in their taxes across the board. But this bill put a stop to all of that. The government essentially said, let's make all that temporary stuff permanent. And those rates that were locked in at 12%, they're not going to go to 15. The 22, it's not going to go to 25. It's saving Americans tons of money. But they didn't just preserve the status quo with this bill. They added in some new provisions, and it creates some massive opportunities for specific groups. The real question is, are you part of one of those groups? Let me tell you about the biggest winners, because if you fall into one of these categories, you need to act fast. First off, it's seniors and retirees. Politicians know who votes, and they just threw seniors a massive bone. If you're 65 years or older, you can take an additional deduction of $6,000 a year. And if you're married, it's $12,000 a year. But here's the catch. If you make too much money, it starts phasing out. So if you're making more than $75,000 a year and you're single, or $150,000 a year and you're married, then this benefit starts to phase out. Second is anyone who makes tips. And this one is huge. Up to $25,000 in tip income is now deductible from your federal taxes. So if you're a bartender, waiter, Uber driver, hairstylist, pretty much anyone who makes tip income, you just got a massive tax break. But again, there are income limits. So if you're single making over $150,000 or married making over $300,000, you're out. You cannot take this deduction. Third are overtime workers, and it's the same deal. $12,500 of overtime pay is deductible if you're single, or $25,000 if you're married. And the same income limits apply, that $150,000 limit if you're single, or $300,000 limit if you're married. You cannot take the deduction. But here's the key with both of these, and this is critical. These are temporary. Both of these are set to expire in 2028. So this isn't a permanent change to the tax law. It is a window of opportunity that you can take advantage of. And finally, it's parents having babies between 2025 and 2028. And this one's going to sound like science fiction, but it is very real. The government is putting $1,000 into a special savings account, a Trump account, and that child can use it on their college education or a down payment on their first home, or start funding their future retirement. This is a huge head start for babies that are born in that window. Now let's talk about something that got buried in the headlines, but it's going to impact millions of people. federal student loans just got completely restructured. And starting July 1st of 2026, there are hard caps on how much you can borrow in federal student loans. So if you're going to graduate school, you can only borrow $20,500 per year and $100,000 lifetime. And if you're going to med school or law school, it's $50,000 per year or $200,000 lifetime. And the maximum that anyone can borrow across their entire education is $257,000. But here's the part that's going to blindside people. If you're currently on certain repayment plans, they are going away. The Save Plan, the Pay Plan, the Repay Plan, and the ICR plan are all getting eliminated. And you have until July 1st of 2028 to select a new plan. And if you don't select a new plan, you're automatically going to get dumped into a plan called the Repayment Assistance Plan. And for most people, that's going to mean higher payments. Way higher payments. And looking at the data and depending on your debt level, we're talking about a 50% to 100% increase in your payments. No, that's not a typo. If you're paying $300 right now, you could be paying $600 in 2028. And the time to plan for this is not in 2028. You need to start planning for that right now. If you live in California, New York, New Jersey, or any other high-tax state, this next change is massive. Let's talk about SALT. And no, I'm not talking about sea salt. I'm talking about the state and local tax deduction. It was set at $10,000, which was kind of low. It's now getting raised to $40,000. And this matters because 90% of people take the standard deduction. But if you're in one of these high tax states, it might be favorable to itemize your taxes again. You need to start collecting those receipts and actually sit down and crunch the numbers of itemizing versus taking the standard deduction. But there is a catch. If you make over $500,000 a year, the SALT deduction reverts back to that $10,000 limit. So the strategy is simple. When you sit down to do your taxes next year, you need to crunch the numbers itemized and using the standard deduction if you're in a high tax state, because the numbers might have just flipped in your favor. All right, so what do you actually need to do? Let me break this down into immediate action steps. If you are a tip worker or overtime worker, you need to start tracking everything. And I mean everything, because this new deduction is only as good as your record keeping. You're still going to be paying payroll taxes on that income. And when you file your federal taxes, you'll get the money back. So you need to set up a system where you can track all your tips and all your overtime, because your future self will thank you. If you're 65 years or older, check your income levels, because if you're close to those income thresholds, maybe you should be considering some income timing strategies. Can you defer some income into the future? Can you accelerate some deductions? Because that $6,000 deduction is a significant tax savings. If you live in a high tax state, it's time to crunch the numbers. Grab last year's tax return and calculate it using the new $40,000 SALT cap limit. And if itemizing saves you money, it's time to start keeping better records of all your deductible expenses. If you have your student loans on one of these repayment plans that's getting eliminated, don't wait until 2028. Calculate what your new payment's going to be under one of the remaining payment plans. And if it's going to be substantially higher, you might consider accelerating your payments on some of these high interest rate loans, or building up an emergency fund so you can handle those higher payments. And if you're planning on having kids anyway, this Trump account thing is legit. Why not have them between now and December of 2028? That $1,000 that the government's going to contribute, and you can contribute up to $5,000 in after-tax dollars each year, that's a massive head start on your child's financial future. Now let's talk about the mistakes that I already see people making. Mistake number one is assuming that nothing changed. Just because the tax rates are staying the same doesn't mean that your situation is the same. These tax credits and new deductions could significantly change your tax strategy. Don't just set it and forget it. Number two is ignoring these temporary provisions. A lot of these provisions are going to expire in 2028. Don't build your long-term future on temporary provisions that are going to go away. Use them while they're here and have a plan for when they're gone. Mistake number three is ignoring these changes to the student loan repayment plans. 2028 feels like it's far away, but if your payment is going to double, you need 3 years to plan for that. And mistake number four is not seeking professional help. And I get it, nobody wants to pay for tax advice, but if you're a high income earner in a high tax state with student loans and business income, the complexity of your taxes just multiplied. And getting help is going to be less expensive than not getting help and getting hit with a significant tax bill. Here's what this all comes down to. This tax bill created winners and losers. And the real question is, which one are you going to be? The difference between these two groups isn't luck, it's preparation. Some of these tax bill changes are permanent, but the very best ones are temporary. There is a window of opportunity from now until the end of 2028. And the winners are going to take advantage of that. And if today's video helped you understand what you need to be doing with this big, beautiful bill, then like the video and subscribe to the channel because I give practical financial tips like this every single week. Keep getting 1% better every day, and I'll catch you in the next video.